Jordan is 26, he's got a job, he's paying his bills, and at the end of every month, there's maybe $80, maybe $100 left over after rent, groceries, and whatever life decided to throw at him that week. He's heard people talk about investing his whole life. His parents mentioned it, his coworkers mention it, every financial influencer on the internet mentions it. And every single time, the advice sounds like it was written for someone who already has money. Open a brokerage account, build a diversified portfolio, max out your Roth IRA. Jordan's sitting there with $60 and a half-eaten burrito thinking, okay, but what about me? This video is for Jordan, and honestly, it's for everyone who looks like Jordan right now, because the gap between I want to start investing and I actually know how to start with almost nothing is bigger than most people realize. The conventional wisdom is that you need a solid chunk of money before investing is even worth it. That's not true, and I'm going to show you exactly why with real options that most beginner content completely skips over. We're going to cover the hidden trap inside apps that look free, a workplace benefit that can lock in a return before the market even moves, a method that's older than the internet that almost nobody talks about anymore, and the one thing that research consistently shows matters more than how much money you start with. And I'm going to save the most important one for last, because it's the one thing that will actually change your outcome long term, and almost nobody frames it the right way. Let's start with the most common entry point for someone in Jordan's situation, because it's where most people go first and where most people quietly lose money without realizing it. The first thing Jordan does is download one of those micro investing apps. You've seen them. Round up your spare change, invest automatically, start with $1. And look, those apps are genuinely useful for building a habit, but there's a number buried in the fine print that almost nobody talks about. Some of these apps charge a flat fee for basic service, like $3 a month. $3 sounds like nothing, but here's the math that changes everything. A monthly $3 charge equals 36% in fees each year if you only have $100 in your account. 36%. That's not a fee. That's a leak in the floor of your account that drains faster than any investment can fill it. At a $3 per month flat fee and a $500 balance, you're effectively paying 7.2% annually, which likely exceeds your investment returns. So the app that feels like it's helping you build wealth is actually costing you more than almost any expense ratio out there, just because the dollar amount looks harmless. The fix here is simple. If you're starting with a small balance, look for platforms that either charge 0 monthly fees or charge a percentage of your balance instead of a flat rate. At 0.25% annually on assets under management, a service like Betterment is the only option where fees scale proportionally with your balance rather than penalizing small accounts. On a $1,000 balance, you pay just $2.50 per year, compared to $36 per year on a flat fee app. The habit of investing is worth building. Just make sure the tool you use to build it isn't eating the habit alive. Now, here's where it gets more interesting, and this one applies specifically to Jordan if he has a job with any kind of benefits package. Working for a company that offers employees an employee stock purchase plan can be a valuable perk that can help you reach your financial goals. Most people scroll right past it during onboarding because it sounds complicated. It's not. Here's what it actually is. Many ESPPs allow employees to purchase their company stock at a discount, most often 15%. So if the stock is worth $10 per share, you pay $8.50. The moment those shares land in your account, you already have a built-in gain before the market does anything. And some plans have a feature that makes this even more powerful. Some plans include a feature called a Lookback, which can increase the effective discount when the stock price is appreciating. What that means in plain English is that in plans with a Lookback provision, shares are purchased using the lower of two prices, either the stock price at the beginning of the purchase period or the price on the purchase date, and any discount gets applied to the lower of those two prices. So if the stock has risen during the purchase period, your purchase price is calculated by applying the discount to the lower beginning of period price, letting you acquire it at a price that's already below current market value. Here's a real example of what that looks like. Say someone is participating in an ESPP with a purchase period from January to June. They contribute $900 and receive a 10% discount with the lookback provision. On January 1st, the stock is $10 per share. By June 30th, it rises to $25. Because of the lookback, they get the 10% discount off the lower January price, buying shares at $9 instead of $22.50. This allows them to purchase 100 shares instead of just 40. The $900 contribution becomes $2,500 worth of stock immediately after purchase. And the part most beginner content skips entirely is this. An ESPP with a discount can be a valuable financial benefit even when shares are sold immediately after purchase. Employees buy stock at a below market price, creating an immediate gain that does not depend on future price movements. You don't have to hold the stock and hope. By selling immediately or soon after purchase, you could possibly secure the gain generated by the company discount and minimize the risk of holding the stock long term. If Jordan's job offers this and he's not using it, he's leaving money on the table every single pay period. Check your benefits portal. Ask HR. This is one of the most underused financial tools available to someone in their 20s. Now, I want to show you something that's been around for decades but has basically been buried under the noise of every new app that launched in the last 10 years. Direct stock purchase plans are specialized investment programs that allow individual investors to purchase shares of a company's stock directly from the issuing corporation or its designated transfer agent. By removing the traditional brokerage firm from the equation, they offer a unique pathway for retail investors to build long-term equity positions. No brokerage account required, no app. Some of the largest and most well-known firms in the United States offer these plans, notably companies like Walmart, Coca-Cola, Intel, and Starbucks. And the minimums can be surprisingly low. Some companies let you get started with $25 to $50, and a handful even sell shares at a small discount to market price. These plans often have low or no commissions and allow dividend reinvestment and fractional shares, making them a smart choice for steady, low-cost accumulation. The reason almost nobody mentions these is that apps are newer, flashier, and easier to market. But if Jordan wants to own a real share of a real company with pocket change and no middleman taking a cut, this is one of the oldest and most direct ways to do it. To invest through one of these plans, you open an account with the company or its transfer agent, deposit funds or link your bank account, and request a trade. You also have options to set up automated recurring trades and dividend reinvestments. It's not complicated, it's just not talked about. There's one more thing I want to mention before we get to the most important point in this whole video, and this one is about something that looks free but isn't. You've probably heard the phrase commission-free trading, and yeah, most of the major apps today don't charge you a visible fee per trade, but there's a reason those apps are free, and it's worth understanding. Many of these platforms make money through something called payment for order flow, where they sell your trade orders to market makers. It doesn't cost you a fee you can see, but it does mean your execution price can be slightly worse than you'd expect. The app is free because the product being sold is your trade. That doesn't mean you should avoid these platforms, because for most people starting out, they're still a reasonable option. It just means free is doing a lot of marketing work and you should know what's actually happening under the hood. Okay, here's the one that matters most. The one I've been holding back this whole video, because it's a thing that actually separates people who build something from people who never quite get started. It's not the app you choose, it's not the stock you pick, it's not even the amount of money you start with. Research on retirement plan enrollment has found something that sounds almost too simple to be true. Automatic. Tiny recurring contributions build a lasting habit far more reliably than sporadic larger deposits. Meaning someone who sets up $5 a week automatically and never thinks about it again will, over time, outperform someone who waits until they have $200 to invest in one shot purely because of consistency, not returns. The psychological trick of set it and forget it is doing more work than the investment itself in the early stages. Jordan doesn't need a windfall. He doesn't need a raise first. He doesn't need to wait until he figures it out. The thing that changes his financial trajectory isn't the perfect strategy. It's starting something small, making it automatic, and not stopping. Every single option we talked about today works better when it's on a schedule. The ESPP contribution comes out of every paycheck automatically. The DSPP lets you set up recurring transfers. Even a basic brokerage account lets you automate a weekly deposit. The amount matters less than the automation does. So here's where Jordan actually is at the end of this video compared to where he started. He walked in thinking he needed more money before he could begin. He's walking out knowing that a $3 monthly fee on a $100 balance is a 36% annual cost. That his job might be offering him a 15% instant return on stock he can sell immediately. That he can buy shares of major companies directly without a broker for as little as $25. And that the single most powerful thing he can do right now is automate something small and let consistency do what a big one-time deposit never could. If this opened your eyes to options you didn't know existed, drop a comment below with which one surprised you most. I read every single one. And if you want to go deeper on exactly how to set up your first real investment account from scratch, even with almost no money, that video is right here. Go watch it.